started so that if anybody is tuning in and is interested in figuring out how they can save some money, so for anybody who has come and to our Tuesdays, which this is our Teamwork Tuesdays, we call it. It's 4 o'clock on Tuesdays where I'm interviewing just different people who are very involved with small businesses, people who are self-employed, and have a business, and the things that affect our businesses help us save money. And one of the people that I've wanted to bring on for some time now is my personal CPA, which is Cherie Sayban. So Cherie's here with me, and Cherie also is a small business owner. And so, which I always like when I work with someone that they understand what it's like to own a business, to have to look at their taxes. And, you know, the big thing with taxes that before I have Cherie kind of introduce herself, is that what I have found through the years is whenever you own a business and it's tax time, first of all, most of us avoid it like the plague, first of all. Cherie, don't you dare share about how I do my taxes. But most of us, like, we keep track of our stuff in a certain way, and we will throw it at our accountants and ask them to put together our taxes and tell us how much we owe. Like, that's typically, I think, what a lot of people do. And where the shift has happened for me as I started working with Cherie over the last few years is, if you do your taxes that way, I don't think you're going to be able to get all the write-offs that you really could have if you had a great relationship with whoever you work with and you talk to them about how to strategically get all the write-offs. That's what I found was, if you're doing it after the fact, you probably aren't getting all of them versus strategically planning. And I'm going to give you a couple examples because that's how I've learned them, is by Cherie and I talking. And literally, from getting a new car at a certain time of the year in a certain type of car that has saved us $14,000 in taxes alone just this year, last year's taxes. There's just little things we all could be doing if we knew how to do them correctly. And so I'm going to just let Cherie just for a second introduce herself. And then I made a little list that we're going to go over of the things that I thought were ones that any of you listening might not realize you could write off. So Cherie, if you want to kind of introduce yourself and your experience in accounting and working with small businesses.
Excellent. Thank you, Megan, for having me, first of all. I have been a CPA for over 20 years now. I did have some experience with obviously working in a local tax firm or accounting firm that had grown substantially. I chose to go on my own after having children, wanting to stay home with them and raise them. And since then, you know, I have worked with small businesses, larger corporations, but I do really like specializing with the small businesses such as yourself and 1040 clients.
And what clients?
1040 clients, you know, individuals, you know, small business owners, Schedule C.
Perfect. And small businesses, I know that they're technically classified as businesses that have less than 500 employees?
Yes.
But I would
Which is crazy.
Yeah, because what would you say your typical client looks like?
Honestly, probably like less than 20 employees. Sometimes they're even just self-employed. There's a lot of that, or, you know, even just 1 or 2 employees. There's a gamut, you know, anywhere from real estate to, you know, manufacturers to, you know, car dealerships. So.
Yep. And I was sharing with you before we went live, what's really interesting, and I bet a lot of people, I shouldn't even say bet, I know that a lot of people that are self-employed and they don't even really know how they report or what gets written off, right? From doing loans, because, and I'll use some very general numbers here to help understand some of these, because I remember when I was in college taking my tax class, I had no idea what any of the numbers meant until I started like purchasing my first investment property and working with the accountant I would work with. I'm like, oh, that's what mortgage interest is. That's what this is. The more you start learning about this, I swear, the more money you will save yourself. It is just unbelievable what you can do if you start just being a little bit aware of the things that you can do in your business with your taxes. And so the first one that I wanted to bring up and talk about is, I shared with you that in the last few weeks, I've looked at 3 different tax returns for 3 real estate companies, brokerages, and all 3 of them reported as different business types, meaning they're on different schedules, they're taxed different ways. Like, if you could just share a little bit about what a business needs to look at. And let's use, I used this last week, your single real estate agent, for example, since, you know, we work with a lot of real estate agents. Why would someone, you know, be a sole proprietor versus looking into being an LLC and being an S Corp? Like, what considerations should they think about?
Well, first of all, when they're first starting off, everyone generally leans towards the sole proprietor because they don't know how their business will grow. They're generally working the real estate business along with having a real job. I see that frequently, you know, where they have a W-2 job, but then they're also working their real estate business or building their business.
No, I did not know that.
At that point, you know, they're just reporting their income on a Schedule C. If they were to switch to an LLC, generally it's still a single member, which would still be a Schedule C, but there is some protection as far as advice that you're giving, you know, and how, you know, legally somebody can, you know, respond with you. If you have in an instance of 2 real estate agents joining as a team, that's where you can come into either a partnership or an S Corp. Each of these are taxed at different rates. You know, say for example,
you have to have 2 people to consider being an S Corp?
No, you can actually have a single member, you know, on an S Corp at 100% ownership. It's not often that you see that. Generally, it's because they've started off with partners, and then the partners have either left or, you know, sold their interest back to. But it is rare to see a 100% owner of a S Corp.
And so, since that's probably one of the most like one of the things, maybe if anyone's listening now or later, if they are a sole proprietor that's on a Schedule C, which is the most normal, right?
Yes.
If they instead reported as that S Corp, and you might have been going in that direction, like what does that change for them? Does it save them money? Does it not save them any money with taxes?
There is some initial savings. We'll just say, for example, they made net income of $10,000. If it flowed through to, you know, their Schedule C as a sole proprietor, they will obviously have their federal tax, which would be at that amount, just 10%. But then they are also responsible for their Social Security and Medicare. They have to pay in basically the employee portion and the employer portion. So it's 15.3%. If they were an S Corp, it would, you know, the S Corporation would file or would pay for the employer portion. And as a schedule, you know, as a as a member of the S Corp, they would actually take a paycheck, receive a W-2.
Yeah.
And on that, they would only be paying the 7.65 of Medicare and Social Security. The remainder of the income from the S Corp would flow through to their tax return via the Schedule K-1, but that is not subject to the self-employment earnings. It's only subject to the federal tax.
So pretty much they'd be saving, let's say, about 7.5% in taxes.
Possibly, yes.
So, and that was something I know that we're an S Corp, for example, and that's where you can W-2 yourself, or you can
Yes.
W-2, right? Just to make
You are expected to take a reasonable compensation if you are an S corporation.
Got it. And I do have a little sheet that I'll pull up here. Let me see, I'm just making sure that I lost my spot here. And I'm sorry if anyone's listening, I'm just trying to, all right. So decision between doing the single member S Corp, and I'm sorry guys, this is why I have Cherie on here. If you're a sole proprietor, is that self-employed tax of 15.3% versus if you end up being able to file as an S Corp, you have to W-2 yourself. And instead of, and I know it's not just black and white, that 15.3, it can help reduce down some of those taxes. So it's not 15.3, it could be closer to 7.65 on that portion. Am I saying that correct, Cherie?
You are, yes.
Okay. Because I know that's something that a lot of people, you know, what should I be? I'm not sure. And so that, and everyone who's listening, like always consult with whoever it is you work with. One of the best things that I ever did when Cherie and I started working together was once a month for 15 minutes, she jumps into a meeting with us and we go over our financials and we look at what we should be doing so that we're not falling behind. And even if you're in the example we used, if you're a real estate agent, like having that advisor, even if it's quarterly, is where I think you could really benefit from, like having that advice and planning at least the next quarter ahead, right? So the next one, you know, without going in, there's so many entities. So one of the things that a lot of businesses will do is it's going to be around vehicles, okay? And I know that a lot of people know with their vehicles, they'll look at, okay, I can write off one thing or the other. I can write off my mileage, which usually is what a lot of people do, or I can write off, what's the second one, Cherie?
Actual expenses.
Okay, which would
and
include
that's where depreciation,
okay,
the gas, insurance, the interest on your car loan, everything associated with that based on the business usage. So whether or not you are using the standard mileage deduction or the actual cost, you do need to be keeping a very detailed log of your mileage. You know, start off at the beginning of the year recording, you know, your beginning mileage. Every time you go on a trip, you write down, you know, the purpose, where you know where you're going to, the total miles. There are even some apps out there that will help you track it. If you use QuickBooks Online, they even have that as an option on their app as well. With the actual expenses though, one of the things how I was able to help Megan tax plan a little
this was the big one,
is, you know, by purchasing a large SUV, you know, for example, an Enclave, a Tahoe, Suburban, a Q7, you can just kind of Google the cars that actually qualify for this.
mm-hmm.
You can take the Section 179 deduction on this if you have income at the end of the day through your business. And that is, you know, is up to the point where the business percentage you're using. And in this case, you know, there is in real estate, especially as much as they've been traveling, there is, you know, a substantial percentage that can be used for business purposes.
And I think I'm going to pull my screen up. I want to show everyone this because, and I'm going to use the example of my car because it's not a secret. Like, I didn't need a new car. I had a Suburban that was, I don't know, it was like 3 or 4 years old, and I have a lot of kids, and so I need this big car. But it had about, I want to say, I think it had like 60,000 miles on it, never had an issue. And we knew that in 2019, we wanted to get as many write-offs as we could. And so it was in like November that I called Cherie and I'm like, what can we do to reduce down our taxable income? And this is when we started talking about getting the car. And you don't have to get a new car. And this is what I'm going to show you with the car that I got. Because, you know, I need to see things visually. So I'm going to share my screen so anyone watching can see this example here. I want you to see how it saved us. It will save us once we file our taxes. Can we see the screen here? Let me see if it comes up. So let's see, I don't say it up yet, but we're going to get there in a second. So right here in the middle of the screen, you'll see it says section 179 expense. And I'm going to put your car. I'm going to put car, even though section 179 is not just cars, but I wanted anyone listening to understand it's not just mileage and actual expenses, that there is this third other option that you might not realize. So let's pretend here that our taxable income for my business was going to be $100,000. It's a really easy number to understand. If our taxable income that would flow through to you personally, if you have a business, this income is going to be taxed at whatever your tax rate is. Okay, so let's say that tax rate, just for ease, is 30%. That means that even if you don't pull that income from your business, you're going to owe $30,000 in taxes. Correct, Cherie?
Yes.
Okay, so if you use what's called this section 179 expense, like I did, I had my Suburban. There's this list of vehicles that I looked at, and I went through the list and started looking around for, it does not have to be new. It can be a used vehicle. So I found a used, what is my car? I don't even know what it is.
A7.
An A7.
Or Q7. Q7, I think.
Q7. Oh my gosh. My husband heard me saying this. So I have a Q7, beautiful car. It's nicer than my Tahoe in a different way, but it was used. And I got it with like 30,000 miles. It was like just under 40,000. I want to say I got it for like 39,000. Well, this section 179 expense allows you, if you own a business, every so many years, every, let's say, is it 3 years, Cherie?
5.
It's 5?
5 for automobiles.
So if you have multiple people who own the business, you know, you can alternate this. So last year, we knew we needed to write it off. So by buying that vehicle, it deducted like that 40,000 that we bought the vehicle for. You can write the entire car off in 1 year. So if you have a huge year, you can write the whole vehicle off. And what that does is now, instead of being taxed on 100, we are getting taxed on 60,000 of taxable income times that 30%. Okay, which means our taxes are going down from, what is that then, Cherie? I don't even know if I have a calculator near me. Let's see. So all of a sudden now, instead of it being 30,000 in taxes, our taxes are now going down to 18,000. I mean, that's huge, right? It is saving us $12,000 in taxes by picking a vehicle, a used vehicle, which is the payments less, and then we write off, instead of getting depreciation spread out over time, we write it all off in 1 year. Can I write off the gas I use? What can I still write off over writing the whole vehicle off?
Yep, absolutely. Over the rest of the, the remaining 4 years, you will then end up writing off your actual expenses of the gas, insurance, things like that, repairs, based on the business usage percentage that you calculate every year based on your log. So you can still, especially, this is ideal for those that live in their car, like realtors, for example.
And how many realtors would you say you see using this?
Well, I have just a handful of the clients, but all of them do. But I'm sure there are a lot of realtors out there that might not necessarily be as aggressive on this, and, not necessarily taking the Section 179, and just taking the standard mileage deduction because they felt that was the safest way, or they weren't able to track all of their expenses specifically related to that vehicle.
And so what other things can be 179 expenses? Because
Anything, any type of fixed asset purchase, your computers, your, furniture for your office, printers, things like that. Now, there is also a bonus depreciation. So you can choose to use Section 179 or the bonus depreciation. The bonus depreciation is only on new equipment. So say, for example, in your case, your car would not qualify for the bonus depreciation. With the Section 179, the state, for example, Pennsylvania, only allows 25,000, even though for the government it's over $1 million. So there are some, federal to state differences as far as how long you can write something off. So in the case of your car, we can only take 25,000 for Pennsylvania, which means the remaining 4 years there is still some depreciation for tax purposes in the state of Pennsylvania.
Right. But for us, that was huge to have that. And then in the next years, right, you look at using something else. So that was something that that I knew about. I used it. I've also seen people who will buy their vehicle, use the Section 179, but then they'll lease a vehicle when they go travel distances.
Yes.
Why would they do that then? Why would they lease a vehicle if they're driving any type of distance?
It's ideally, if depending on their family situation, if they're going to stay within the miles, then yes, leasing is usually an okay deal.
I'm sorry, I didn't clarify. Meaning they don't go lease another vehicle, but like I've heard people say, so that they can get the best bang for their buck when they sell the car or turn it in, they will go to like a Hertz, right? And they will rent a car when they have to drive somewhere.
I think in that situation, because if they were leasing, they didn't want to put the mileage on, and they think that they can, obviously they could use the rental car as their expense,
True.
because part of their travel. Yes, exactly.
So those are just little like things I've seen people do or talk about that I wanted to make sure I shared that
yes,
I didn't understand. I don't think I've ever, I really don't. Maybe I did and I didn't know it, but I don't think I've used this before last year when I started really getting proactive.
It does include, because I thought I saw a question pop up about, if it was financed. Yes, like in your case, the car was financed, so one of the items that, also counts as, an expense would be the interest portion of that loan as far as an actual expense.
Yes, thank you. Perfect. So I'll move on from this one. This is something too, if there are, whoever's listening, if there are real estate agents listening, I see this all the time. As loan officers doing mortgages, we can add back depreciation. I know there's a lot of loan officers that don't realize that Section 179, because it's called an expense, it's really depreciation. We will get tax returns sometimes that look like the company's losing money, and they've got hundreds of thousands in Section 179 expenses that we add back, and they have a ton of income we can use. So that's always been one thing that always fascinated me was this write-off. So the other one that I never knew about that we're starting to use that we have never used is hiring your family, hiring your kids, and I could be understanding it incorrectly. So I'm going to tell you how I understand it. And then if you could kind of educate us. So when you own your own business, as long as you're the single member, I believe it is, because there's rules if you have partners, but for real estate agents, since we're using that example, you can pay children who are under the age of 18, and let's say you pay them, like, and I know there's a max on it. So let's say you pay them, for example, for stuffing envelopes, doing your social media. Let's say you pay them $5,000. You get to write that off on your, like, as a deduction from your income, and your children do not get taxed on that, if I'm correct, Cherie. Am I correct there?
It's a portion that's not taxable. They still need to, they will need to, prepare payroll taxes, payroll tax returns, actual paychecks for the children, but it is not subject to all of the taxes. You won't need to withhold the federal withholding because they won't reach that limit. If they're under the age of 18, then it's also not subject to the employer portion of like FICA and Medicare. You do have to withhold the state and local taxes, obviously, and they're exempt from the unemployment, so it is a good way as long as you are documenting exactly what they're doing. And, obviously you can't have a 2-year-old filing.
I was just going to ask that. How old do they have to be? And I know I've asked you this because, so I have 4 kids and they're young. I mean, they're 12, then one's 9, 4, and 1, right? So I know that the 1 and 4-year-old are not working, although my 9-year-old and my 12-year-old, they do things at my office. They will come in here, they will help with little things around, they'll stuff envelopes, they'll do stuff like that. And if I'm paying for, like, if there are things that they specifically, I purchase them or that they do, and I'm paying them, I can write that off. They're not taxed on it, right? Like, how would someone handle that?
Well, again, there really should be where they are receiving a paycheck
From, so like from a company that does payroll, should it be through payroll?
Yes, absolutely. But okay, since, obviously in your situation, it's a little different because you do have a partner. Right. So I'm going to revert back to, just a single realtor, yeah, for example. Obviously they have to file, or follow, the employment laws and child labor laws. You can't be having them work all hours of the day. But you can issue them an actual paycheck, for, let's just say, you obviously have to worry about, minimum wage because, the employment laws. But, even if you're paying them $10 an hour, to do the filing, things like that, you can then also spin it around a little bit. If they're old enough, you can set up a Roth IRA for them and then have the money that they actually earned from their paycheck go into their Roth IRA.
Which is, and that grows tax-free, right?
Yes, exactly. Because, a 12-year-old doesn't necessarily need the, paycheck income, unless you're having them spend for their, little video games and things like that.
Right. And then, so you're writing it off, they're not taxed, it goes in, it's growing. I mean, it's just one of those things that the compounding effect of it could be tremendous if you do this year after year. I mean, you don't need to do it for 5,000, even if you did 1,000, 2,000, and you're at that 30% tax bracket, every $1,000 you pay them, you're saving $300. Right? Roughly. I'm using these rough numbers. I know that they're not exact.
It's graduated. Yeah.
It's graduated, but I think most of us, because I haven't really used this one, we're just getting paid and we pay ourselves from our business, and then we're paying things for our kids if they've helped us or not. These are the types of things you can be aware of if you have children and they are doing things in your business. And you lose some deductions and you pay more in taxes when you own a business. That the deductions that are there to learn about them and use them is where you're going to save money. So that one I thought was really cool. And Cherie, what if they're over 18? Does that change anything?
It just changes the, on the Social Security, Medicare, and the um, unemployment. But at that point, it's a free for all as for how much you can really pay them, because, as long as they're legally working your business, you can pass through quite a bit of the income to them.
Is there a cap on it?
No,
There's no cap on it?
I don't think so. I would have to actually research that. But,
That's okay.
it's because especially the fact that if they're over 18, they're an adult at that point. So
then they're taxed.
yes. Yeah.
Okay. And so anyone over 18, they're taxed. This is just for under 18.
Mm-hmm.
Okay. So that is hiring your family members. I skipped over one, I believe, right here that I wanted to go over, which was the qualified business income, which is a 20% deduction. I know that was a new one in 2018. If you could just walk through what is that and who can actually take this 20% deduction?
It's a
and I know it's kind of confusing because I've heard it before and I'm like, what is it?
It is. It basically applies to almost any small business. And it is basically, 20% of your net income which is, either, from your Schedule C or, even if you have a partnership or an S corporation, those calculate and flow through to the individual as well. So it's a nice little tax savings that they've put out there for the time being.
So let's say, like in my example, if someone's net, right, is 100,000 up here,
Mm-hmm.
right, and they're eligible, does that mean that they're not taxed on 100? They're taxed on 80,000?
Basically, that's what it comes down to, because I'm just going to assume that this is a single, like a sole proprietor realtor again, just keeping with the consistency today. You would have the $100,000 showing on the income, and then before AGI, there is a line specifically for the qualified business income. So it does come off for federal tax purposes in calculating your AGI.
Why did they do that?
It started with the tax year for 2018.
Mm-hmm. Huh, that's really interesting because it's like people who are self-employed pay this extra tax, right? The self-employed tax. Yes. So I was curious if that's why they did that.
Well, no, because you're still going to be paying the Social Security tax on it. It's just a way of, I'm not even quite sure, honestly,
why it was just part
of the, right. I mean, it was a big part of the, Tax Act, the Tax Cuts and Jobs Act. And I think they were just trying to help stimulate the economy a little bit by providing the discount to the small business owners.
Interesting. So then
I know this.
Go ahead.
I was going to add something that realtors might not necessarily be thinking of is even the home office deduction.
Yeah.
Because obviously, they do have, an office, for whichever real estate agent they're working with, but then they can also take the home office deduction as well.
And I think I have seen that too, where not everyone takes that home office deduction, but
a lot of people think that that's going to be a red flag for an audit, and it's not, as long as you do have a home office, like say for example, an extra bedroom that you aren't using, it does have to be solely for business purposes. It can't be like, oh, I'm going to have, a bed in here in case I have a, relative come in from out of town. It does need to be set up solely for business purposes, and they do have to work out of there predominantly, but then that'll allow them, say for example, it's a 10 by 10, room in a 2,000 square foot house. It would be, 100 square foot against the 2,000 square foot. And then from there, you can take that percentage of your mortgage interest, your real estate taxes, your utilities, repairs, anything like that, your insurance. So that's another great deduction. And I can tell you, in all the years I've been doing taxes, I have not seen anyone audited because of a home
Right.
office.
Right. And gosh, I mean, I think everyone this year is going to be eligible for the home office deduction after COVID-19.
Yes.
Right?
Pretty much, because everyone's had to set something up.
Yeah. I mean, it's for real. Because one of the other questions I've heard is, and maybe it has to do with more with the car, the driving, like very specifically. So if someone who has a home office, they write off their home office, but then there's like a main office, right? Can they write the mileage off, or can they write off from driving from their house to the office, or no, it's only when they're going and like meeting clients or showing houses?
It would only be when they're meeting clients, because, they are a 1099 independent contractor.
Mhm.
But, generally the office that, the real estate company has is, not necessarily conducive. Like, it's not a permanent, office for all the agents. It's just a, hey, here it is in case you need to meet for, before closing, things like that. But generally it's just for going and meeting your clients and, going to the open houses, things like that.
Right. Well, that's interesting. And then, of course, because once I started realizing there's all these great little write-offs, I bought like this book of write-offs to go through and make sure I wasn't missing any that I wasn't telling you about. And I remember I found one in the book for if you have a watchdog. Remember, I think I asked you about this.
Yes.
But it's right, like there
it's
are
a security system.
I mean, we definitely have watchdogs, but I know you have to be careful. Like, why would overwriting off things that you don't specifically buy for the business, for example, what risk would that cause to anyone who owns their own business and writes off things like that?
Obviously, you could be at risk for an audit from the IRS. And, obviously in that case, they would, if they felt something was not a legitimate deduction,
Right.
They would just take it off as an expense and then recalculate your taxable income at that point. If it's, a gross misstatement, I think it's like 20%. If
Mhm.
if you understated your income by 20%,
Mhm.
then they can actually go back as far as they want to audit. Otherwise, it's a 7-year audit period.
Oh, gosh, that would be horrendous.
Yes.
The other one I put on here to go over here as we're wrapping up is, where did I put it here? Here we go. Deducting entertainment expenses, like the meal. Remember how meals and entertainment changed? And then I think didn't I hear that they announced something that they might be actually adding it back in or something? Did you hear that?
I have not heard that yet. So at this point, no entertainment has been allowed for I think like 2018 and 2019. And what that means is, if I wanted to take you to see the Erie Otters, I cannot write off those tickets. However, if I bought you dinner either before or at the game,
Okay.
that the food itself is a deduction, but I can't, any entertainment, golfing with your clients is not a deduction
So buy
anymore.
food no matter what you're doing entertainment wise.
Correct. Yes. Because it's a meal and you're discussing business things.
Right.
To it's not, just like if I'm going out to dinner one night, I just can't write it off. I have to actually be meeting with somebody, a potential client or a customer, things like that.
I had another one here, but I wanted to make sure I was seeing questions. So someone had a question on, Does this only apply? Okay, finance the vehicle. We know we went over that one. And then how much of the meal is deductible?
You will list 100% on the tax return, but only 50% is allowable for federal purposes.
Okay.
Surprisingly, Pennsylvania allows the whole deduction.
Oh, well, and that's always been a question for me because, like, for example, my husband and I, right, we invest in real estate together,
Yes.
but like I have my own business, my mortgage business that he has nothing to do with, and he has a real estate business I have nothing to do with. But when we go out to eat, I mean, we talk about our rentals, we talk like our businesses all the time. How would you look at something like that for those of us who, you know, you and your spouse, for example, or a family member or whatever, is that you're in the same types of work and you sit down to eat and go over things for work?
That, in the case we're going to use you and Laban as the example, obviously, um, if it was truly just regarding your rental properties, I personally don't take those
Mm-hmm.
for you, because first of all, they're on the Schedule E. There's, for rental properties, there's nowhere for meals and entertainment because, obviously it's not directly related.
I guess I'm meaning no matter where it gets written off as,
True.
like, can you write off things like that if it's on the Schedule C on the business? If you're really discussing items that you meant to go over.
That's definitely pushing the gray area,
Okay.
especially, because if it is just you and your husband, but let's throw a third person in there. Let's just say, I wanted to look at a home. Laban is trying to show me the house. I'm working with you for the loan.
Mm-hmm.
We go out to dinner to discuss everything. That absolutely is a write-off.
Okay. Let's make sure I didn't, there's another question on here. It says, as self-employed, we often need to show our profit and loss statement when trying to get credit. Do all these deductions also make it look like your business is less profitable? Yes. That's a frustrating thing on the lending side, whatever your 1099 that you get from, let's say we keep using you sell real estate, right? You get a 1099, let's say for 100,000, you write off these things and your net income is 40,000. The bank is going to look at it and use 40,000 in income for when you're qualifying for things. Now you're paying taxes on 40,000, not 100,000. So you're definitely getting that benefit. And that's why in the last 2 years, these bank statement programs that came out, they're great for anyone who is self-employed because they're looking at the deposits into the bank account. They're not looking at that Schedule C and what your net income is on it. And there's one thing to keep in mind with this, because a lot of people who would use these programs, the rates are higher on them. Let's say they're 2-3% higher, right? I remember looking at one because the individual's like, oh, I don't want this higher rate. I'm going to work on my taxes so I can report more income and qualify to get a lower rate. Well, the higher rate was probably costing someone $100 a month, right? The higher interest rate costs them in their mortgage payment or whatever payment it is you're getting, the rate's going to be higher because it's a higher risk. You're not showing all your stuff. So that's $1,200 in a year. Well, if you go and report more income, don't write your 100 off down to 40,000, just reporting 10 more thousand, depending on your tax bracket, right there, you're going to pay 3,000 more in 1 year. Like, take the higher interest rate in the bank statement program and save your money on your taxes. And, so there are ways you can work around it, but yes, as much as you write off, that's what most lending institutions are going to look at as the income that is left after you have all these expenses. One tip I would give any of you is, because I don't see many people do this, and Cherie, maybe you can add to this on like how you are organizing your finances. If you are self-employed, right? If you are self-employed, but let's say it's not like a business, it's just you, create a separate account. Create a separate business account. Don't just have one account that you deposit your checks that you get in there, and you also like pay your groceries out of there and your kids' daycare and your utilities. Have a separate account that every single check you get, you deposit into that account. And anything that relates to your business, pay it out of that business account. Because if you we'll keep using real estate agent, but this could be an insurance agent, this could be a dentist. You have a separate account that you deposit your checks in, and then you transfer yourself into your personal account, right? Money. If in that business account that your checks go into, if you pay your car out of there, you pay a credit card out of there, if you pay like any of these things that show up on your credit report, if we can prove that you have a separate account and that you pay your stuff, your car, a credit card you use for business out of there, if you try to get a loan and we can show that you've paid it out of the business account, we can exclude it. And then it doesn't cause that whole problem about less income, but you still have a car payment, or you still have, you know, certain credit cards. So that's just a little tip or trick that you can do for qualifying for things on the loan side. It also, I'm sure, helps your accountant if you have that separate account.
Absolutely. I even recommend, at a minimum, start a spreadsheet of, you know, your income and expenses, or use Quicken, or even if you're even a larger company, QuickBooks. It will help you understand on a monthly basis exactly where you are profitability, and it's not scrambling at the end of the year trying to find all your receipts that are packed away in a box to deliver to your tax advisor.
You're not looking at me, are you?
Honestly, no. I'm actually talking about some other clients that have given me just envelopes full of receipts or boxes. I'm more than happy to go through those, but you know, if you're more organized, you know where your business is throughout the year.
Right. One other one I read here quick, and then we're going to wrap up, is one of the ones I read on here, it says the office, it was like firearms. So for anyone, the heavy SUV, and it says the possible deduction of concealed carry and firearms training. Is that true? Can you rate that off?
I would have to investigate that. I have never had anyone inquire about that.
Yeah, I just, you know, I'll see little things here and there. So I was curious because I think it's, if I should houses or rentals or whatever, I would probably consider carrying, because it's that's tough. What about so when I used to not be self-employed, when I worked for someone, I had unreimbursed business expenses. If you get a W-2, like I used to, because I would drive all over, I would get gifts for people, for closings, for the people I worked with. Even though those people are not self-employed, but they have their own business within someone's business. So that would be like the loan officers that work for me and my company. What can they do with these expenses that they have?
Unfortunately, at this point, those unreimbursed expenses have been tabled as an expense. There is no write-off for federal purposes at this point. If you're in the state of Pennsylvania, fortunately, they still do allow those. So it does, you know, minimize your income there. But yeah, unfortunately, you know, that was as part of the, you know, Jobs Act, they took that away, which is disappointing.
It is disappointing. So like one of the things that we had talked about for our group was, you know, hey, if there's a way to make it something that can come out of their paychecks and the company pays for, that would be a way to work around that. Awesome. Is there any that I did not bring up? I know I didn't do 10, but I really want to make sure that I finish this up before the end of the hour. And then there will be a link here under this live that there's going to be a download that we will send to anyone who clicks on the link. And I apologize, I had a sheet here, but we had some issues with trying to get it into a PDF. So if you put your email there, we will send over just a little tip sheet that talks about some of these write-offs. But are there any I did not ask you about that you see and that people don't really realize that would be good to just keep at the tip of their, their minds? Or where can they reach out to you if they are looking for someone who will work with them, help them understand what they can do, Cherie?
Absolutely. I think we hit the biggest topics right now because everybody has a little different situation that might be unique to them or their business. So it's hard to navigate exactly which ones to pinpoint for them. They can visit my website, CherieSaybanCPA.com, reach out to me there. You also, Megan, can go ahead and publish my business phone number.
Okay.
With that.
We'll put that there, your email. Does that sound good?
Yes, please.
Okay.
They can reach out to me if they have any questions. Happy to, do a small consult to discuss, any questions they might have, or if they even need, if they've been doing their own tax returns and think that they are missing some deductions. I'm happy to kind of consult with them on that as well.
Yes. And Cherie's amazing. I'm telling you, having someone who will work with you, who will meet with you monthly, like I can't even explain how much it can save you and how much it's refreshing. I'm sorry. One last question I just thought of. If someone doesn't pay their quarterly taxes, like how much is that costing them? Like, why is it smart to do the quarterlies?
If depending on who you're speaking with these days, especially with the value of money and how low the interest rates are and things like that, the penalty for not paying the quarterly estimated tax payments is really not necessarily that high. I will still always schedule my clients for paying the quarterly estimated in, because you should get into the habit of making sure you're getting it paid in timely. Where the IRS will really hit you hard is filing late, like filing your tax return late after the extensions, things like that. That's where they will crush you on penalties. But truly, like I've seen clients owe $10,000 and their penalty might only be $100.
Okay.
Where, like if, unfortunately, well, before COVID, and the stock market was actually doing really well, they were clearly earning more than $100 on that $10,000. It made more sense to have that invested.
Oh, yeah. Okay.
So,
or they could even write a check for $100 a quarter, right? And that still, would that do it?
No, it's actually based on, like, they'll look at the prior year's tax return and they expect to see, generally 100% of your tax liability. So like just using 2019, for example, they're going to look at your 2018 tax return. As long as you're under a certain AGI, they're going to expect you to have 100% of that tax liability paid in. Otherwise, that's where you will end up seeing the small penalties.
Okay, cool. Well, I appreciate you and your advice and for coming on and answering these questions, because I'm always, trying to share some of the stuff that's helped us and help other people, and us small businesses can use all the help we can get right now until we're out of COVID. So thank you. And I'll make sure I post your website and your email in the comments, and hopefully I answered everybody's questions. So and there's a link to download the 10 tax deductions for self-employed. So you are welcome to go and download that with the link that is in the comments below the video here. And we will be back every Tuesday. We'll be coming back each Tuesday with just a different person, a different interview for just different topics for small businesses, how to save money, grow your business, ideas, everything. So we'd love to see you back next Tuesday. Thanks, Cherie.
Thanks, Megan.
All right, bye.